ECB to hold rates now but energy price resurgence points to September hike, Reuters. The consensus read is already outdated. What matters now is the second-order effect most commentary still ignores. We will map trigger, incentive shift, and downstream impact before the close. They will. The European Central Bank will hold rates steady, and markets will breathe a sigh of relief. But here's what nobody's paying attention to: energy prices just spiked again, and according to the latest Reuters poll of economists, that's exactly the signal that triggers a September rate hike. This matters because the ECB's entire inflation fight hinges on what happens to oil and gas over the next 60 days. Let me break down what's actually happening. The ECB has raised rates aggressively since 2022, from near zero to 4.25%. Inflation in the Eurozone peaked around 10% and has been cooling. So logically, rate hikes should be done. The bank even signaled a pause. But energy is the variable no central bank controls. When crude spiked past $90 a barrel last week, it changed the calculus completely. The Reuters poll shows 65 economists out of 89 now expect a rate hike in September. That's a massive shift from 3 weeks ago when the consensus was pause for the rest of the year. Here's why this matters for you. If you hold European bonds, stocks, or currency, the ECB's rate decision directly affects your returns. A higher rate environment punishes growth stocks and high-leveraged debt. It also strengthens the euro, which helps European exporters but crushes import-dependent companies. For Indian investors, a stronger euro usually means softer commodity prices over a 3 to 6 month lag, which affects everything from oil imports to metals. And if you work in IT services with exposure to European clients, tighter monetary policy typically precedes a slowdown in consulting spend, which usually hits India's services sector 4 to 6 months later. But here's the contrarian angle that matters: the ECB doesn't want to hike again. They've already done the heavy lifting. Another rate hike in September feels reactive, not strategic. Yet they may have no choice if energy prices stay elevated. This creates what I call a reluctant tightening, a scenario where the bank hikes not because conditions demand it, but because inflation expectations start to slip. Once inflation expectations unanchor, every rate hike becomes exponentially harder to pull back from. The Fed learned this lesson in 2021 and 2022. The ECB is watching that playbook closely. So what changes between now and September? 2 things are critical. First, watch oil and gas prices. If crude stays above $85 and European natural gas doesn't collapse, the September hike is almost certain. Second, watch the services sector pricing data. If wage growth and service sector inflation stay sticky, which they are across Europe right now, the ECB's hand is forced. You're looking at about 60 days of economic data releases that will determine whether September is a hike or another pause. The second-order implication is about credit markets. European banks have been profitable because the rate environment is favorable. A September hike compresses net interest margins and increases default risk on variable rate mortgages and corporate debt. Some European banks could see earnings revisions lower. That's why bank stocks are the canary in the coal mine for ECB tightening. Watch Deutsche Bank, ING, and Santander over the next 4 weeks. If they fall 5% or more on ECB-related guidance, it signals markets are pricing in the September hike as more likely than today's consensus suggests. For Indian rupee economics, this matters in a subtle way. A stronger euro and higher European rates make euro-denominated bonds more attractive relative to rupee bonds. This could pull capital away from Indian debt markets. You've already seen the rupee weaken 4% this year against the dollar, partly because of Fed rate expectations. A more hawkish ECB adds to that pressure. For students or professionals considering euro-denominated education loans or mortgages, this is a signal that borrowing costs could rise by 0.5 to 1% by Q4 2024. One more thing, don't confuse the ECB holding rates today with the ECB being done tightening. Today's pause is not a signal of easing. It's a pause before a hike if conditions warrant it. This is the exact opposite of what happened in 2015 to 2020 when pauses meant the cycle was reversing toward cuts. Today it means the opposite. The ECB is in a holding pattern, and energy is the pin that breaks the pattern. So here's what to monitor: ECB announcement at 1:45 p.m. Frankfurt time, then the press conference at 2:30. Watch the language around future rate decisions. If President Lagarde says something like the possibility of further increases remains on the table, or we remain data-dependent particularly on energy and wage pressures, that's code for September is live. Then over the next 60 days, track the ECB's own energy price assumptions in their forecasts. If they're modeling oil above $85 on average, hike probability climbs to 75% or higher. This is worth paying attention to because every major central bank is watching how the ECB navigates this moment. Everyone thinks the ECB is done hiking rates. Today they pause. But here's what changes everything: energy prices just spiked past $90 a barrel, and the latest Reuters poll shows 2/3 of economists now expect a September rate hike. That's a massive shift in 3 weeks. Why? Because oil and gas inflation is contagious. Once it shows up in the data, central banks can't ignore it without losing credibility on inflation fighting. This creates a reluctant tightening scenario. The ECB doesn't want to hike, but energy dynamics may force their hand. If you hold European stocks, bonds, or have exposure to Eurozone credit, this September signal matters. Watch the language in today's press conference for any hint about further increases remain possible. That phrase changes everything for your portfolio. Focus on 3 layers: immediate trigger, structural incentive shift, and downstream effects on operators, users, and regulators. Then map scenario playbooks: optimistic execution, base case adaptation, and risk case where integration friction or policy reaction slows adoption.